next classification of budgets is on the basis of time. So, on the basis of time, budgets can be classified into three broad categories: long-term budgets, short-term budgets and current budgets. Long-term budgets are normally prepared for a period exceeding 1 year. These budgets are prepared to cover areas such as long-term capital investments, research and development projects, future sales projections, etc. Short-term budgets, on the other hand, may cover periods of 6 to 12 months depending on the nature of the business. Current budgets cover a very short period of time, typically 1 month to a quarter. These are basically short-term budgets which are constantly adjusted to reflect current business environment or current business circumstances. Moving on to the next classification of budgets. There are two broad categories for classifying budgets on the basis of flexibility: fixed budgets and flexible budgets. Fixed budget is a planned budget of expected outcomes. It is prepared on the basis of a standard or a fixed level of activity. These budgets are not changed when the production levels or the capacity utilization change. Flexible budgets, on the other hand, are budgets that are designed to change in response to changes in the output level or capacity utilization. It's a set of alternative budgets prepared to address different expected levels of activity. These budgets provide a reliable basis for comparison because it's automatically geared to changes in activity level. Let us now look at two examples and understand how budgets are prepared. The budgets we are going to look at are cash budget and flexible budget. Let's take the first example. The following information is provided with respect to R Limited. We have to prepare a cash budget for the months of April, May and June 2007. Actual figures for sales, purchases, wages and expenses have been given for the months January, February and March. Similarly, budgeted figures for sales, purchases, wages and expenses have been provided for April, May and June. There is some additional information also given. 10% of the purchases and 20% of the sales made by the company are in cash. The average collection period of the company is half month, which means of the credit sales made in a particular month, 50% of the credit sales are collected in the same month and the remaining 50% is collected in the next month. And credit purchases are paid regularly after 1 month. Wages are paid half monthly and rent of Rs 500 included in expenses is paid on a monthly basis. Other expenses are paid after a 1 month lag. Opening cash balance on April 1st, 2007 is 15,000 rupees. Now, based on this information, we have to prepare cash budget for the months April, May and June. Let's first try to compute the cash inflows. We know that cash sales represent 20% of sales made every month, and cash for these sales would be collected immediately as soon as the sales are made. So, cash sales have been tagged as A in the statement shown on your screen. The remaining 80% of the sales are credit sales and half the credit sales are collected in the same month and the remaining half in the next month. So, for the month of April, 80% of April sales would be 72,000 rupees, that is 80% of 90,000 rupees. Of this 72,000, 36,000 rupees worth of cash would be collected from customers in the month of April itself, and the remaining 36,000 rupees, that is 50%, would be collected in the next month, that is May. Similarly, 80% of May sales, that is 68,000 rupees, would be credit sales of May. Of this 68,000, 50% would be collected in the same month and the remaining 50% cash would be collected from customers in June. So, total cash collected through sales for the month of April, let us say, would be the following. Cash sales representing 20% of sales made in April is 18,000 rupees. 50% of credit sales made in April, which is 80% of total sales of 90,000, of which 50% is collected in the same month, is rupees 36,000. 50% of credit sales made in the previous month, that is March, which would be 80% of the total sales of March, that is 60,000 rupees, of which 50% would be collected in April, is 30,000 rupees. So, in the cash budget, we have to show cash sales of 18,000 rupees plus credit sales of 66,000 rupees, which is 36,000 rupees for April and 30,000 rupees for March. We have to now follow the same process for the months of May and June. The payments to be shown in the cash budget are as follows. Cash purchases are 10% of total purchases made every month and they are paid in the same month. The remaining 90% of the purchases are paid in the next month. So, payment to creditors in the month of April would be 90% of total purchases made in March, that is 90% of 42,000 or 37,800 rupees. Wages are paid 50% in the same month and the remaining 50% in the next month. So, wages paid in the month of April would be 50% of the wage expenses incurred in April and 50% of the wages incurred in the previous month, which is March. So, the amount would be 50% of 22,000 rupees plus 50% of 24,000 rupees, adding up to a wages cost of rupees 23,000 shown against E. Rent paid is 500 rupees per month. Total expenses minus rent are paid in the next month. So, expenses of March minus rent would be paid in the next month, that is April, and this is 5,500 rupees. Expenses of April would be paid in the month of May to the tune of rupees 6,500 and so on. These expenses are tagged as G in the statement shown on your screen. Now, if you plug in all the cash inflows and cash outflows, this is what the cash budget would look like. The opening cash balance plus all the inflows minus cash outflow represent the closing cash balance, which becomes the opening cash balance for the next month. Moving on to the next example, we have to draw up a flexible budget for the following levels of operation: 70%, 80% and 90%. Information given in the problem is variable overheads at 80% capacity are indirect labor of 12,000 rupees, stores and spares rupees 4,000, semi-variable overheads at 80% capacity are power rupees 20,000, power charges are 30% fixed and 70% variable. Repairs and maintenance cost rupees 2,000, repairs and maintenance cost is 60% fixed and 40% variable. Fixed overheads at 80% capacity are depreciation cost of 11,000 rupees, insurance cost rupees 3,000, salaries rupees 10,000, and estimated direct labor hours at 80% capacity is 1,24,000 hours. We have to remember that fixed expenses would remain constant at all levels of production, and it is only the variable cost that will change when the level of production or activity level changes. So, in the flexible budget, let us first list out the variable overheads. We have to update the indirect labor and the stores and spare cost at 80% activity level. These are variable cost and will therefore change for 70% and 90% activity levels. Remember, change in variable cost is always directly proportional to change in activity level. Therefore, at 70% capacity, indirect labor cost would be rupees 12,000 divided by 80% multiplied by 70%, which is equal to 10,500. Similarly, stores and spare cost would be rupees 4,000 divided by 80% into 70%, which is 3,500 rupees. To calculate these costs at 90% level of production, we need to deduct both indirect labor and stores and spares cost incurred at 80% level by 80% and multiply by 90%. When we do that, we get indirect labor cost as 13,500 rupees and stores and spare cost as 4,500 rupees at 90% utilization or activity level. Now, total of variable costs for 70%, 80% and 90% level of production are therefore 14,000 rupees, 16,000 rupees and 18,000 rupees shown as A. We can see from the problem that power and repairs cost appear to be semi-variable costs. Power cost is 30% fixed and 70% variable, while repairs cost is 60% fixed and 40% variable. The fixed portion of power, that is 30% of rupees 20,000 or 6,000 rupees, will remain unchanged for all three activity levels, while the variable portion will change and this change will be completely proportional. So, variable cost at 80% level is 14,000, which will decrease to 12,250 rupees at 70% level. That is 14,000 rupees divided by 80% multiplied by 70%. And this will increase to 15,750 rupees at 90% activity level. Remember, change in variable cost has to always be proportionate to the change in the activity level. You have to give the same treatment to repairs and maintenance cost as well. Fixed cost of depreciation, insurance and salaries will remain unchanged for all three activity levels. So, the total fixed expenses are rupees 24,000 at all three levels. Now, totaling variable, semi-variable and fixed expenses, we find that the total cost of operating at 70% capacity is 58,150 rupees. At 80% capacity, the cost is 62,000 rupees and the total cost of operating at 90% capacity is 65,850 rupees. Labor hours at 80% utilization is given as 1,24,000 hours. Therefore, labor hours at 70% capacity would be 1,24,000 hours divided by 80% multiplied by 70%, which is 1,08,500 hours. Similarly, at 90% utilization, labor hours would be 1,24,000 hours divided by 80% multiplied by 90%, which is equal to 1,39,500 hours. Dividing the total cost by labor hours, we get the standard overhead rate per hour. Moving on to the last concept in this module, zero-based budgeting. Normally, while preparing budgets, previous year's data is taken as the basis for projecting budget for next year. But in zero-based budgeting, an operating plan or budget starts from base 0, assuming that the budget is being prepared for the first time. Each activity to be funded in the budget must be justified every time a new budget is prepared. Every department is reviewed comprehensively and all expenses and not just the increase need to get approved. In some sense, zero-based budgeting reverses the working process of traditional budgeting. With this, we come to the end of the module. Hope you are now conversant with the meaning of budgetary control and how budgets can be used for management planning and control.